We're going to answer some of your questions on asset allocation with Karthik Zaveri. Our first question comes in from Prabhu, who tells us he'll be opting for voluntary retirement at the age of 58, which I'm assuming is soon. He tells us he has about 25 lakh rupees in mutual funds and bonds. He has some exposure to a group of shares, although he hasn't told us the names. He wants us to suggest a couple of funds he can begin investing in for the long term. He doesn't need a monthly income because he'll already have a pension. So this is a great idea, Karthik, because using mutual funds for the long term will help him beat inflation. If he's retiring at 58, for the next 20 years, his corpus is going to have to grow larger than inflation. What would you recommend for him?
I would suggest that you consider putting about a third of your assets into large cap kind of funds, about 35 to 40% of this money into mid cap funds, and another about 30% into sectoral funds. Now, I would suggest you to do two very interesting things while you make this asset allocation strategy. One of the things that we must do is we must try and go to about 2 different schemes in each of these categories. So to say, we need 2 large cap schemes, we need 2 mid cap, and we need 2 sectors to look at. Now, while we do that, we also want to distribute the risk of our investment with various fund management teams. So therefore, each of these 6 products that you will buy will ideally should be from a different mutual fund scheme or a different mutual fund company. So which is to say that you could look at a pharmaceutical fund in a sector allocation, you could look at another logistics or an infrastructure fund. You can also consider banking as an interesting area which is likely to grow for many years to come. So you could probably choose 2 of these sectors from different fund houses, of course. You have a large plethora of mid-cap schemes which have been doing exceedingly well, even in a situation where the markets are not as good as they should be and they are, in a depressed state of sorts. You still have a lot of mid-cap funds which have shown great promise and consistency over the last couple of years. Maybe you can consider them. And in terms of large cap, again, we need to look at 2 large cap. You could also look at multi-cap funds to fulfill this particular requirement of yours. And that's how you should distribute and create your portfolio.
Our next question comes in from Karunesh Singh. He has a lump sum of 40 lakh rupees to invest. He tells us that's in his savings bank account right now. Don't leave money in your bank account. It sort of you lose its value because it's not even beating inflation. He wants to know how he can invest for the next 10 to 15 years. Is there a list of equity funds that we can give him? Should he be staggering his investments? You should definitely be staggering your investments, Karthik, and he should definitely be using equity.
Number one, about the method of investing. Now, the method of investing is obviously a good idea to stagger the investment, which is to say that whatever money you have, why not sort of just break it into a couple of parts and then invest it. What is happening as a result of this is we are going to take the average rupee cost averaging formula advantage, which means to say that just like an SIP where we are doing a monthly investment, when you have a lump sum kind of a money to invest, at that stage we break that money into smaller parts to invest in the equity market. So we start by going into a liquid fund and we then do what is known as a systematic transfer plan. We break that money between 6 to 12 installments, and in 6 to 12 months, so to say, we will deploy the money into the equity market. So what happens here is it's only a deployment strategy, wherein if the market actually corrected at 10 or 15% or 20% at some point in time, and had we invested the entire money, then psychologically we would feel quite bad that we've lost money or we are in the red for the time being. But obviously you want to hold for a much longer period of time, so and therefore in that longer period of time everything would get even out and you would also make great profits in times to come. A fund that might look really nice at this point in time need not necessarily be a fund which is also great 5 years or 10 years down the line. So which is why again one needs to go back to the monitoring and go back to the research desk and continuously keep witnessing the performance of these funds. Many factors affect the production and the performance of a fund. These could be things like the fund manager's decisions. It also could be the market. It could be the external environment. It could be the interest rates. It could be the kind of stocks that are held into these funds which are affected by certain governmental policies. There's a whole variety of reasons why a stock performance could be affected or adversely affected. So which is why again monitoring is something that you cannot eliminate and you need to keep watching it. What you don't want to do is constantly churn it, or every time there's a 5 or 10% profit, you don't want to really book profits and move out, and because then you will be hit with exit loads and capital gain tax. You don't want to do that. Yes, you want to invest for the long term, but keep a very close watch.
Alright, and on your screen right now are our aggressive mutual funds that have been recommended on this show. So if you have your time horizon and you want to make a lot of money and you're willing to take that risk, these are the funds that you should be using. Last question comes in from Radha Singh. He has 40 lakh rupees in bank deposits making about 8.4% interest. He wants to know if he should close those deposits and put the money in mutual funds instead because rates are decreasing. He wants to know if there's any way he can make a return of 15% over the next 5 years. Well, in my opinion, equity would be the only way to do that. But remember that 15% is not guaranteed. Karthik, what would you recommend?
Equities will definitely give you a 15% plus rate of return, but it has a certain amount of rules that you need to follow. Prima facie, the rule being that when you invest in the equity markets, you need to consider that your investment time frame is going to be definitely in the range of 5 to 10 years at the minimum. If you're going to do SIPs, it's going to be 10 to 15 years. If you're going to do a lump sum investment today and then do an STP route and then slowly move that money, you're still looking at a bare minimum of 5 to 7 years. You could be really lucky and 2 years the equity markets could rally and you could make a lot of profit, but that's obviously not the ultimate objective because you want multiplier in terms of wealth creation. So you will get your returns, but you need to really determine whether you are on the wealth creation side of your life or whether you are on the protection side of your life. If you have adequate assets and if you don't need the volatility in your life, then think about fixed interest investments like tax-free bonds and like your fixed deposits. If you are on the mode where you need to create wealth, where there is a pronounced reason to create wealth, then think about equity investments.